Okay, hello class, how we doing? I'm going to be presenting another online presentation, PowerPoint, on Chapter 18. Because of the 3 snow days and the President's Day, I think in order to keep you guys up to the other class and on track, we need to do this online video. So, please watch this on your time so that when we get to class on Friday and go over this in class face to face, we can really go through it much faster, okay? And this will, again, help us catch up with the other section. So Chapter 18 is looking at short-term finance. The outline is cash account, cash increase and cash decrease, receivables and payables, and again, the operating cash and cash cycle. 4 areas that we want to touch on. So the way I put this together is I want to look at the big overall statement, which is assets equals liabilities plus owner's equity. Now I'm drafting that in this way. Assets is debt, which includes short-term and long-term, okay, plus equity. So this is all a liability, but short-term and long-term, okay? Another way to look at this, in this case, you could probably call it assets equals liability, okay, plus equity, because we do have some short-term liabilities, hence the current liabilities. So if we have this, okay, and let's just follow closely. If we want to rewrite each of those categories, total assets includes current and fixed. So that's where I have this. Equals liabilities includes current liabilities and long-term debt or long-term liability, okay, plus equity. Now, what I did here, as I just subtracted current liabilities from each side, so that wipes out current liabilities on the right side, okay, and it brings it over to the left. So it rewrites the equation as CA minus CL, okay, plus the fixed assets, okay, equals all this, okay. So that should be pretty apparent. Now remember, from the previous chapter, net working capital is current assets minus current liabilities. Current assets includes a couple of things, cash and non-cash items, okay? That's really, we'll get into that later, what exactly is a non-cash, but current assets are cash and non-cash items. That's accounts receivable, inventory, etc. All current assets. Okay, so we know that equation. Let's move to the next. If I bring that equation up to the top again, here we are, okay? And remembering that net working capital is CA minus CL, okay? Now, if we know that is true, in that case, we can rewrite this statement another way. This data set here, we can plug in, call it net working capital, right here, the green. Fixed assets comes back and equals all this, okay, here. Okay, so now we've rewritten as net working capital plus fixed assets equals long-term debt plus equity. Okay, so I've just rewritten this from the slide before. Now, we know that net working capital is CA minus CL. So, if we know that, let's look at what we can do. We can take the cash, keep that on the left-hand side, okay? Of all this, we're going to keep cash on the left-hand side of the equation and move everything else over to the right-hand side, So we have cash equals long-term debt and equity. That's already on the right-hand side of the equation. Now we need to bring over CL, it's positive, okay, minus the fixed assets, minus the non-cash current assets, the NCCA. Okay, so cash stays on this side. Everything else gets bumped over to the right side of the equation. Okay, so if we look here, all this stuff comes over. With the only thing within that is cash. The other thing left is CL. Okay, and we accounted for it here. So that's our new equation. Okay, NCCA is non-cash current assets. So if I take that equation, I'm going to rewrite it on slide 6. Cash equals long-term debt plus equity plus current liabilities minus cash, okay, non-cash current assets minus fixed, okay. Now, remember, we can now look at activities that increase and decrease cash, okay. Long-term debt, okay, when that goes up, that increases cash. When equity goes up, that increases cash. When current liabilities, remember, accounts payable, when that increases cash. When non-cash decreases, okay, that decreases cash. When fixed assets go up, that decreases, a negative. So fixed assets, if that goes up by 10, it's going to take away, it's going to act as a negative. Non-cash current assets, remember, accounts receivable, inventory. When those increase, that's going to reduce cash. That's why we have a negative. So when this is positive, it increases cash. When this increases, it increases cash. When this increases, it increases cash. When these increase, it'll decrease cash. When this increases, it will decrease cash, signified by the negative, okay? Okay. So, with that understanding, that base of knowledge, we're going to look at the operating cycle, okay? And the, excuse me, the operating cycle equals the inventory period plus accounts receivable period. Now, let's see what that looks like on a grid. Look at this. Okay, this is a hypothetical scenario. We picked, let's say, day 0, day 30, day 60, and day 105. Let's say a company acquires some inventory. Okay, let's say I'm the company, I purchase some inventory from you. Okay, on this day. I call in, make the order. Okay, I get the order, I get the materials, but I don't actually pay for it for 30 days. So I pay for the inventory 30 days from that point. Okay, then it takes me about 30 days to sell the inventory. So 30 days later, at the 60-day point, I'm able to sell the inventory. So I sell it to somebody, sell it to customers. Then on day 105, I'm able to collect on those sales. Okay, so 45 days later, I collect. So I acquire, I pay, I sell, and I collect. That whole time frame, okay, it's 105 days. This period is called accounts payable period. It's 30 days. So I get the inventory here, I pay for it here. That's a 30-day accounts payable. Here I sell the inventory and then I collect. That is called the cash cycle. Okay, from this point, from 30 to 105. So that's important to remember. Excuse me. This is an accounts payable cycle, period. This is a cash cycle. That's 75 days from day 30 to 105. Okay, day 30 to 105. That's because, think about it, I paid for it on this day. I didn't collect anything until this day. That's my cash point. Now, let's look at some calculations of the operating cycle. Okay, so in some accounting and finance, what we do is we take an average. So let's say our inventory at the beginning of the period and the end, it can be 1 year, but let's use 1 year. That's the best. But it can be a quarter, it could be a month. But in this case, let's keep it simple, 1 year. We start at 2,000 at the beginning, we end at 3,000. So we check the inventory in the warehouse at those 2 points in time. What we want to do is take the average. Okay, so 2,500. Accounts receivable, the same thing, the beginning year, the end of the year. Accounts payable, the beginning of the year, the end of the year. Okay, we record that and take the average. So these are the numbers we're going to be using, the average. If we look at our income statement within that time period, we see we made 11.5 million. Cost of goods was 8.2 million. Okay, that's pretty simple. Now, what we want to do, like we did in class, we're trying to come up with this equation. And we did this in class, cost of goods over the average inventory. So I just made up a little diagram, hopefully to make this simpler. If we think of a warehouse of goods, we've used up 3.28 of the boxes. So if this is entire inventory warehouse, if we sell 2.5, then we sell 2.5, 2.5. Here we actually sold not the entire lot, but part of it, 0.28. So we 3.28, one box, one section, and then partial, okay? So if we want to come up with the inventory turnover, remember it's cost of goods over the average inventory. This number is from this slide, okay? 8.2 million over, what's the average inventory? Well, if we look at, if we go back and we look at our inventory, we see that we have 2.5 sitting in inventory. Okay, 2.5 sitting in inventory. If we sold that much, our inventory is 2.5 in the warehouse now. That tells us we've turned over that inventory 3.2 times, 3.28 times. Okay, so 2.5 is coming from 4. Okay, I'm sorry, 2.5 times 4 equals 10 million. Okay, this whole thing, we've used up 8.2 of all this stuff. Okay, that leaves 1.8 million. Okay, 2.5, one of these sections minus 1.8 is 700,000, or 28% of 2.5. There's our 2.5. Okay, so it's really, to recap, the inventory turnover is how much we sold, cost of goods sold, okay, over what's sitting on average in our inventory, and that's 2.5. And that happens 3.28 times. Okay? Because apparently we didn't really sell this full lot, only a portion of it. So that's how we come up with this number. Now, if we want to see, again, in class, we want it's this next equation is simply putting it in more layman's term, something we can identify with. It's putting that number into days out of the year. So 1 year is 365, obviously. So the inventory period is 365 over that turnover period, which is 3.28. So 111 days. That's inventory to sales. So it took 111 days to go from inventory to sales. That's the conversion period. So this was all sold, all that was turned over, that was turned over, and a partial was turned over here, 0.28, okay? Now, receivables. Now we want to see what we sold, and from what we sold, what did we collect on that? Okay? What's still sitting on the receivables, and how much cash do we have? Okay, so the first one is going from warehouse to what we sold. Now this is from what we sold, what did we receive? How much cash did we receive? So we sold 1.5 million. Receivables, we look back, we have 1.8 million sitting in receivables. So that's simply AR. Sales is 11.5. AR is 1.8. Receivables turnover is credit sales, which is this number, over the 1.8. And that's 6.4 times. So it happened over the course of 1 year. We sold something, we collected, we sold, we collected, we sold, collected. That happened on average 6.4 times. Since 1.8 million is sitting in receivables, the implication, we can infer that we sold and then we collected cash 6.4 times. Okay? The higher that number is, the better. So if we had sold, think of it, if we had sold 11.5 million worth of goods, and we looked on the AR and we saw 11.5 million, that would be essentially no turnover. We sold it and it's all sitting on the books. Okay? So that would have been basically a 1. So the higher this number, the better. And again, we convert this into days, something we can understand. If that's the turnover, into 365 days, so 57 days. So it basically, it took me 57 days on average to collect from the sales. So the operating cycle is looking at inventory period, accounts receivable period. So we have 160 days equals the total operating cycle, and that's coming from the 111 days on average in inventory. So from warehouse to cost of goods sold, and then it's taking on average 57 days to collect. Okay, that's the 57. So remember, here's the 111 days to go from inventory to cost of goods sold, to selling it. This is from sales to collecting. And then we get this. So this is sort of the summary of all that. 111 days, 57 here. If we add those two together, we have 168 days to go from the point that we acquire the inventory to we collect cash. And that whole point is called the operating cycle. Now, let's shift our focus over to payables, okay? When we get something and we pay for it, okay? So the overall picture that we're focusing on, getting closer and closer to is we want to what? Shorten the days of when we receive our money, collect our money, and in essence, lengthen the days, stretch out the days from when we pay for goods, our payables. So, cash cycle is the operating cycle minus the accounts payable. Or, another way, we've just finished with this one, the operating cycle. That's inventory period plus AR minus whatever we get from the accounts payable. Okay, that's another way to look at the cash cycle. So we have operating cycle, cash cycle. Okay, we just finished that. Now we're looking at the cash cycle. So let's see what that looks like with some numbers. Okay, again, the same chart. We're calling this the cash cycle. Same numbers here. Inventory, AR, AP. We have the beginning of the year, the end of the year. Now we want to really look at the average. Okay? This is the same chart that we looked at earlier. Okay, I just copied it. Okay, same income statement. 11.5, cost of goods sold is 8.2. Same chart. Now, the payables turnover is costs of goods, what we used, what we sold, how many when we sold something, the cost of goods that went into that product, the average. Okay, so we sold 8.2 million. That's this. 8.2 of the cost of goods. On average, it was 0.875. Let's see where we found that. Cost of goods sold. Accounts payable was 0.875. Okay. Average payables. Okay. Payables turnover, cost of goods sold over the average payables. We found that number. We found this number. It's 9.4 times. Okay. Payables period is, again, nothing more than the full 365 days over that time period. And again, this is probably something you want to think of it this way. Make that period very slow because and there's an ethical component that I'll talk about in class about that, because you don't want to stretch out your payables and not pay your vendors, when it's actually due. When it's, you don't want to not pay them within the normal time frame. So we'll talk about that in class. But here, okay, that's 9.4. Over 65 is, so 39 days, that's telling me that I am paying my bills within 39 days. So if you can stretch that out without harming the relationship with your vendors, then that's okay. So cash cycle, 39 days to pay the bills. Cash cycle equals the operating cycle. Okay, we got that from earlier slide. That's 168 minus the 39 days to pay my bills. So that cash cycle is 129. So 129 days from purchasing the inventory to collecting cash. Okay? And so that's basically it. In conclusion, remember we're looking at what decreases accounts receivable. We want to decrease the time frame that it takes us to receive cash. And in essence, you want to increase when you pay your bills. But again, we have to be careful with this. We don't want to be unethical. We don't want to rip off our vendors. But if they're able to give us 30 days, you might want to pay in 30 days. Don't necessarily pay in 10 days, because if you have lots of payables and you pay within 30 days legally, honestly, then you're holding on to a lot of money that you can do something with. If there are gaps in your AR, that might warrant some financing. Okay? Meaning, if you're having a hard time collecting money, you might have to go out externally and raise some money, okay, to fill that gap. Gaps in payables, meaning I've got some extra money before I have to pay my vendors, that might open up some investment opportunities that you can take that money and invest in the short term, 30 days in a certificate of deposit, a CD. So those are sort of the underlying implications of payables and receivables. Okay, that is it. Thanks, guys, and I will see you in class.